So, you've done everything right. You save that deposit, your income is looking good, you might even be pre-approved. You find the perfect place, and then suddenly the bank just stops. Why? Well, it's because getting that loan isn't just about you. It's just as much, if not more, about the property itself. So, let's open up the lender's secret rule book and see what's really going on.
You know, it's got to be one of the most frustrating parts of buying a home. You've checked all the boxes, but your deal gets held up, or worse, totally rejected because the bank has a problem with the actual house. It can feel really personal, but I promise you it's not. For them, it's all about risk. And their idea of what's risky can be surprisingly and sometimes maddeningly specific.
And this all comes down to a key concept called acceptable security. It's the industry jargon for whether a lender thinks a property is a safe bet or not. See, they're not just giving you money, they're investing in that building. And if that asset doesn't fit their own private rulebook, it honestly doesn't matter how perfect your application is.
And here's where it gets really tricky. There is no single universal set of rules. As this quote makes crystal clear, a property that one bank is falling over itself to finance might be completely rejected by the bank next door. It really creates a minefield for buyers who just assume, pretty reasonably, that all banks basically see property the same way. They don't.
Okay, to really see how wild these differences can be, let's just zoom in on one of the most common property types with some of the most complicated rules, the humble apartment. You'd think it would be simple, right? Oh no, it is anything but.
Right, take a look at this. The difference is immediate and it's stark. Westpac has a hard, non-negotiable rule. If the internal living space is under 40 square meters, it is a hard no. Game over. But then you look at ANZ and BankWest. They'll consider it. But, and this is a huge but, they seriously cut back how much they're willing to lend. They cap your loan-to-value ratio, or LVR, meaning you suddenly need a much, much bigger cash deposit to bridge that gap.
So, if there's one number to remember here, it's this: 40 square meters. It has become the unofficial magic number in the lending world. It's the baseline that most lenders use for what they call a standard apartment. You dip below that number and you're entering a whole new world of special conditions and much, much tougher rules.
And this example just perfectly shows how extreme the policies can get. We're talking about the exact same property type, a serviced apartment. If you take that deal to CBA, they've got a policy where they'll at least look at it. Take that exact same property to BankWest, it's an immediate absolutely not. No discussion.
And look, this isn't just about apartments. These secret rulebooks are thick with details on all kinds of properties. Thinking of a rural block? Well, one bank might be fine with 50 hectares, but another starts getting nervous at just 10. Does the property have a rare company title? Some banks will say no way. Others will say maybe. They even keep track of how many loans they have in a single apartment building to make sure they're not too exposed if something goes wrong. It's that detailed.
Okay, so let's say your property gets past all those initial hurdles. The type is okay, the size is okay. Great, but you're not out of the woods yet. Next up, you've got to face what I call the valuation gauntlet, and this is where the lender decides what your dream home is actually worth in their books.
Now, to do this, a lot of lenders start with tech. They use something called an automated valuation model, or AVM. It's basically a super complex algorithm that crunches a ton of data, recent sales, location, property features, to spit out a value almost instantly. It's fast, yeah, but it's a computer model. It's not a person who has actually walked through the front door.
And this, right here, is the million-dollar question. Literally, utilally. You signed a contract saying you'll pay a certain price, but the bank's valuation, whether it's from their computer or a real person, comes back with a different, lower number. What happens then?
Pay close attention to this because this is absolutely critical for any home buyer. The policy at many major banks is totally inflexible. They will always use the lower of the two figures, the purchase price or their valuation, to calculate your loan. So if you agree to pay $1 million but their valuation is only $950,000, they're only going to lend you a percentage of that $950,000. And that $50,000 gap? That's on you to find.
Now, if you thought the rules for buying an existing home were a lot, just wait. When you're building a new home from scratch, things get even more complicated. For the lenders, it's a much bigger risk, and you better believe their rulebooks reflect that.
The whole process really hangs on this thing called an as-if complete valuation. A valuer has to look at your empty block of land and a stack of building plans and basically predict the future. They have to estimate the final market value of the home once it's built. But the real challenge, as you can see in Step 4, is that every lender has a different level of confidence in that prediction.
And these are some of the biggest red flags you'll find.
Is your builder on a cost-plus contract instead of a fixed price? A lender like Westpac gets really twitchy and might immediately slash how much you can borrow. Thinking of being an owner-builder to save some money? They get even more cautious. And for some things, like trying to buy a home that's already half-built, some banks just say, nope, not interested. Full stop.
So, after all that, all these different rules and red flags, what's the big takeaway? Well, the point of all this isn't to scare you off. It's actually the opposite. Knowing this stuff is meant to empower you. It gives you a massive strategic advantage when you're out there in the market. And this sentence right here really sums up our entire explainer. The secret to a smooth home buying journey isn't just about falling in love with a house. It's about understanding what makes that house unique and then strategically matching it to a lender whose very specific, very detailed rulebook actually sees that property as a good investment.
Which, of course, leaves us with the one big question you need to ask yourself. It's not just about, can I afford my dream home? It's also, is the bank I'm talking to even compatible with this home? And trust me, finding out the answer to that question before you sign on the dotted line, well, that can make all the difference in the world.